The landscape of retirement planning undergoes a dramatic transformation when individuals reach age 73, marking the beginning of a new phase where the Internal Revenue Service demands its long-deferred share of accumulated retirement wealth. This milestone triggers the commencement of required minimum distributions, a federal mandate that fundamentally alters how retirees must approach their financial planning and tax management strategies. While these distributions represent an unavoidable reality for most Americans holding traditional retirement accounts, the tax implications need not become an overwhelming burden that erodes decades of careful wealth accumulation. Required minimum distributions emerge from the government's recognition that tax-deferred retirement accounts cannot remain sheltered indefinitely. The IRS designed these mandatory withdrawals to ensure that the tax benefits originally granted when contributions were made eventually generate revenue for the federal treasury. However, this well-intentioned policy creates significant challenges for retirees who may find themselves facing substantial tax bills precisely when they are living on fixed incomes and seeking to preserve their remaining wealth for potential long-term care needs, legacy planning, or unexpected expenses. The mathematical reality of required minimum distributions can prove particularly jarring for successful savers who accumulated substantial balances in their traditional retirement accounts. These distributions are calculated based on account balances and life expectancy tables, meaning that larger account balances generate proportionally larger mandatory withdrawals. For many retirees, these forced distributions can push them into higher tax brackets than they experienced during their working years, creating an ironic situation where retirement brings higher effective tax rates than career peak earning periods. Understanding the mechanics of required minimum distributions provides essential context for developing effective mitigation strategies. The IRS calculates these distributions by dividing the prior year-end account balance by a distribution period factor based on the account holder's age. This formula ensures that account balances will theoretically be depleted over the account holder's expected remaining lifetime, though market growth can often sustain or even increase account values despite ongoing distributions. The distribution amounts increase each year as the divisor decreases with advancing age, creating a trajectory of steadily rising taxable income throughout retirement. Strategic Roth conversion planning. Among the most powerful tools for managing required minimum distribution tax burdens, Roth IRA conversions stand out as a strategy that can fundamentally reshape a retiree's tax landscape. These conversions involve transferring assets from traditional tax-deferred accounts to Roth IRAs, where future growth occurs tax-free and no required minimum distributions apply. While conversions trigger immediate tax liability on the converted amounts, they permanently remove those assets from the calculation base for future required minimum distributions. The timing of Roth conversions requires sophisticated analysis of current and projected tax brackets, market conditions, and personal financial circumstances. Optimal conversion strategies often involve identifying years when taxable income falls below normal levels, perhaps due to reduced consulting income, significant medical expenses, or market downturns that have temporarily reduced other investment income. During these lower income years, conversions can fill up current tax brackets at relatively favorable rates while reducing future required minimum distribution obligations. Converting assets during market downturns presents particularly attractive opportunities, as depressed account values allow larger numbers of shares to be converted at temporarily reduced tax costs. When markets recover, the appreciation occurs within the tax-free Roth environment rather than adding to traditional account balances that will eventually be subject to required minimum distributions. This strategy effectively allows retirees to time their tax obligations to coincide with favorable market conditions while positioning future growth in the most tax-advantaged accounts available. The analysis of conversion opportunities must also consider the impact on other aspects of the tax code, including Medicare premium calculations, Social Security taxation thresholds, and state tax implications. Large conversions can trigger higher Medicare Part B and Part D premiums through the income-related monthly adjustment amounts, which are based on modified adjusted gross income from 2 years prior. Similarly, conversion income can affect the taxation of Social Security benefits, potentially creating a cascading effect where conversion taxes are magnified by additional taxes on previously non-taxable Social Security payments. Qualified charitable distribution strategies for philanthropically minded retirees. Qualified charitable distributions represent an elegant solution that satisfies required minimum distribution obligations while supporting meaningful causes and providing significant tax advantages. These distributions allow direct transfers of up to $100,000 annually from traditional IRAs to qualified charitable organizations, with the transferred amounts counting toward required minimum distribution requirements without being included in taxable income. The tax benefits of qualified charitable distributions extend beyond simple income exclusion, creating advantages that often exceed those available through traditional charitable deduction strategies. Since qualified charitable distributions are not included in adjusted gross income, they avoid potential limitations on itemized deductions while also preventing increases in modified adjusted gross income that could trigger higher Medicare premiums or increase Social Security benefit taxation. For retirees who no longer itemize deductions due to increased standard deduction amounts, qualified charitable distributions provide charitable tax benefits that would otherwise be unavailable. Strategic implementation of qualified charitable distributions requires careful coordination with overall charitable giving plans and cash flow needs. Retirees who regularly support charitable causes can redirect their traditional giving through qualified charitable distributions, effectively using pre-tax dollars for philanthropy while reducing their overall tax burden. This strategy proves particularly effective for retirees whose required minimum distributions exceed their annual spending needs, allowing excess retirement account assets to flow directly to charitable causes without first being subjected to taxation. The timing and structuring of qualified charitable distributions can be optimized to maximize their tax efficiency within broader financial planning objectives. Some retirees choose to concentrate charitable giving in specific years to maximize the impact of qualified charitable distributions, while others prefer steady annual distributions that provide predictable tax benefits and support ongoing charitable commitments. The key lies in integrating qualified charitable distribution strategies with overall retirement cash flow planning to ensure that charitable objectives align with personal financial security needs. Proactive distribution management. Traditional thinking about retirement distributions often emphasizes delaying withdrawals as long as possible to maximize tax-deferred growth. However, this approach can lead to larger account balances that generate substantial required minimum distributions in later years, potentially pushing retirees into higher tax brackets when they have less flexibility to manage their tax obligations. A more sophisticated approach involves strategic early distributions that smooth taxable income over multiple years while providing greater control over tax bracket management. Implementing proactive distribution strategies requires careful analysis of current tax brackets, projected future tax rates, and cash flow needs throughout retirement. Retirees in relatively low tax brackets during their early retirement years may benefit from taking larger distributions that fill up their current bracket while reducing future required minimum distribution obligations. These additional distributions can be reinvested in taxable accounts where they provide continued growth opportunities while offering greater flexibility for tax management and estate planning. The decision to accelerate distributions must be balanced against the benefits of continued tax-deferred growth and the potential for future tax law changes. Market conditions also play a crucial role, as taking large distributions during market downturns can lock in losses while reducing future growth potential. Conversely, strategic distributions during periods of strong market performance can capture gains while account values are elevated, potentially reducing the number of shares that must be distributed in future years. Cash flow considerations add another layer of complexity to proactive distribution planning. Retirees who do not immediately need additional income from accelerated distributions must determine how to deploy these funds most effectively. Options include funding taxable investment accounts, prepaying major expenses such as home improvements or healthcare costs, or providing financial support to family members during their own peak earning years when the tax benefits may be more valuable. Asset location optimization. The types of investments held within different account structures can significantly impact the growth rates of required minimum distribution calculations and overall tax efficiency throughout retirement. Traditional tax-deferred accounts that hold high-growth investments will experience more rapid balance increases, leading to larger future required minimum distributions. Strategic asset location involves positioning different types of investments in the account structures that optimize their tax treatment and growth characteristics. High-growth equity investments often perform best in Roth IRAs, where their appreciation occurs tax-free and never becomes subject to required minimum distributions. Meanwhile, more stable income-generating investments such as bonds and dividend-paying stocks may be better suited for traditional retirement accounts, where their steady returns can support required minimum distributions without creating excessive account growth. This strategic positioning can moderate the growth trajectory of traditional accounts while maximizing the long-term benefits of tax-free growth in Roth accounts. International investments present additional asset location considerations due to foreign tax credit opportunities and currency exposure. Foreign tax credits generated by international investments can only be claimed if the investments are held in taxable accounts, making them potentially less suitable for tax-deferred retirement accounts. Similarly, currency hedging strategies may be more easily implemented in taxable accounts, where the associated costs and complexities do not impact required minimum distribution calculations. The rebalancing of asset locations must be accomplished through careful coordination of new contributions, conversions, and distribution strategies rather than simply moving assets between accounts in ways that could trigger immediate tax consequences. This process often requires several years to implement fully, making early planning essential for maximizing the benefits of optimized asset location strategies. Medical and long-term care planning. Integration. Healthcare expenses represent one of the largest and most unpredictable costs facing retirees, while also offering some of the most valuable tax deduction opportunities available. Integrating required minimum distribution planning with healthcare cost management can provide dual benefits of reducing tax burdens while preparing for inevitable medical expenses that increase with age. Health savings accounts represent a unique planning opportunity for retirees who maintain high-deductible health insurance plans. While contributions to health savings accounts may not be possible for Medicare beneficiaries, existing account balances can continue growing tax-free and provide tax-free distributions for qualified medical expenses. Strategic coordination between required minimum distributions and health savings account withdrawals can optimize the tax treatment of healthcare costs while preserving other retirement assets. Long-term care insurance premiums, within specified limits based on age, qualify as medical expense deductions that can offset required minimum distribution income. For retirees anticipating significant long-term care needs, using required minimum distributions to fund insurance premiums can provide both immediate tax benefits and future care cost protection. The deductibility limits increase with age, making this strategy more valuable for older retirees facing larger required minimum distributions. Home modifications for aging in place, such as installing accessibility features or medical equipment, often qualify as deductible medical expenses when recommended by healthcare providers. Using required minimum distributions to fund these improvements can provide immediate tax deductions while enhancing quality of life and potentially reducing future healthcare costs. The key lies in proper documentation and ensuring that modifications meet IRS criteria for medical expense deductibility. Estate planning coordination. Required minimum distribution planning cannot be separated from broader estate planning objectives, as the strategies employed during life will significantly impact the assets and tax obligations passed to beneficiaries. Different types of retirement accounts receive varying treatment for inheritance purposes, making the composition of retirement assets an important estate planning consideration. Inherited traditional retirement accounts generally require beneficiaries to take distributions over 10 years, with all assets withdrawn by the end of that period for most non-spouse beneficiaries. These inherited distributions retain their tax-deferred character, meaning beneficiaries will owe income taxes on withdrawals. In contrast, inherited Roth IRAs also require 10-year distribution but provide tax-free income to beneficiaries, making them significantly more valuable for wealth transfer purposes. The interaction between required minimum distributions and estate tax planning requires careful consideration for wealthy retirees whose estates may approach federal or state estate tax thresholds. Required minimum distributions reduce taxable estate values while generating income tax obligations, creating a complex interplay between income and estate tax planning. In some cases, using required minimum distributions to pay life insurance premiums or fund irrevocable life insurance trusts can provide estate tax leverage while managing current income tax obligations. Charitable remainder trusts and other charitable planning vehicles can provide sophisticated solutions for retirees with substantial retirement account balances who wish to support charitable causes while providing income for themselves or their families. These strategies can effectively convert required minimum distributions into charitable income tax deductions while providing ongoing income streams and supporting philanthropic objectives. Implementation and professional guidance. The complexity of required minimum distribution tax planning demands careful coordination among multiple strategies and ongoing monitoring of changing circumstances. Tax law modifications, market conditions, personal health changes, and family situations all impact the optimal approach to managing required minimum distributions. Professional guidance from qualified tax advisors, financial planners, and estate planning attorneys becomes essential for navigating these complexities effectively. The implementation of required minimum distribution strategies often requires several years to achieve optimal results, making early planning crucial for maximizing available benefits. Retirees approaching age 73 should begin evaluating their options well in advance, allowing time to position assets appropriately and coordinate various strategies before required minimum distributions begin. Regular review and adjustment of required minimum distribution strategies ensures that planning remains aligned with changing circumstances and objectives. Annual planning meetings should evaluate the success of current strategies, identify new opportunities, and adjust approaches based on evolving tax laws, market conditions, and personal circumstances. The investment in professional planning and ongoing management of required minimum distribution strategies often pays for itself through tax savings and improved financial outcomes. The complexity and stakes involved make professional guidance a wise investment for most retirees facing significant required minimum distribution obligations. By implementing thoughtful strategies and maintaining ongoing professional relationships, retirees can successfully navigate the challenges of required minimum distributions while preserving more of their wealth for their own use and their legacy objectives.